Good afternoon and welcome to the MANOLETE Partners PLC Interim Results 2024 Investor Presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to CEO Stephen Cookling. Good afternoon to you, sir.
Good afternoon, Alessandro. Good afternoon, ladies and gents. Thanks very much indeed for joining us once again. Just to remind people, we did one of these not so long ago, maybe 6-8 weeks ago, I forget exactly when, because our annual results were delayed because of the change in an auditor. We bought a very big case off the insolvency side of their firm. So we will keep it fairly light touch today, just because this really is a kind of update to what we presented just a short while ago. So for those who don't know me, Stephen Cookling, chartered accountant, chief executive and founder of the company. Previously chartered accountant, qualifying with Coopers & Lybrand. That was the old name for at least part of PwC, and then spent around 20 years in corporate finance, and then started this business in 2009. Mark, do you want to just give a brief intro?
Yeah, hi. I've probably met most of you. Mark Taverner, chartered accountant as well. Most of my career I spent at Deloitte in transaction services and corporate finance, and I've been with MANOLETE for the past 5 years.
Super, thanks, Mark. That's the agenda for today. You'll have seen this slide, many of you, before. Very brief recap. We are the UK's, by far, the leading specialist insolvency litigation financing company. The big difference between ourselves and the other listed companies and indeed private companies in this space is that because we only do insolvency cases, about literally 99% of the cases we do, we own. So we are the claimant. We bought it off the insolvent company or the liquidator or the administrator. And that gives us unique control over that case because it's literally our case. It is MANOLETE. If they ever go to trial, it literally says MANOLETE Partners PLC versus Joe Bloggs. So we can choose the lawyers. We can set out the key strategic steps of the case. We can make a settlement offer to the other side. We can respond to one from them. And we can fix costs, as we always do with our solicitors, and manage the whole thing through. And insolvency is the only area of English law where you can do this. We have a long track record of 16 years. We have purchased 1,500 cases, near enough. We've completed just over 1,000 of those with aggregate settlements, about £152 million from those 1,000 completed cases. We are by far the market leader. I should stress, and people do get slightly confused on this point, this is a new way of doing, well, it was 16 years ago, a new way of doing insolvency claims, the MANOLETE method, this assignment purchase method. Most insolvency practitioners still use the old method that is far less effective, called the no-win, no-fee method, along with some ATE, expensive ATE insurance that may or may not respond to any cost claim. But the funded part of this industry has been growing every year. So it's around 25-30% of the whole. And MANOLETE is by far the biggest, 67% market leader of that third-party funded element of the whole. But just a reminder that the growth comes from not taking share off other litigation funders. The next closest to us has only got 4% market share. It's from transitioning from the old method of doing this to the new. Now, the trouble is in professional services, accountancy, tax, insolvency, it takes time for people to change the way they do things, relationships, etc. But I think everyone is pretty convinced that this is the maximum outturn for the creditors. I'm just hearing a bit of a jingle. If others could mute their microphones, that'd be helpful. Consistently high returns. We'll come on to that in a minute on the vintages table. I'll get into more detail. So this is the very up-to-date insolvency service graph published on their website, which shows that before the COVID pandemic, there are around 1,500 companies going insolvent in the UK every month. As you can see, there was a very sharp dip when COVID hit the UK, and that was for two reasons. Number one, the government of the time suspended for a 2-year period many of the insolvency laws, so it was very difficult for creditors to push companies into insolvency. And also, of course, the government threw a huge amount of liquidity at the UK business sector, about £500 billion, and therefore very strong decrease in insolvencies. When those, in April 2022, that was a very big inflection point because the laws got back to normal and the government stopped throwing all that money at the UK business community. And since that time, as the board anticipated, the level of insolvencies has persisted at very, very high, much higher levels than it was before the pandemic. I think what gives us confidence that that, if that's the right word, that the levels will persist yet further into the future, into the foreseeable future, is that coming out of the pandemic, the business owners, business directors were faced with obviously very high interest rates. They now don't seem to be likely to come down quite as fast as people thought they would do a couple of months ago. Inflation very high, still supplier issues, global conflict, Ukraine and Gaza. And then I think more recently, the Labour government, early days in their tactics, obviously, to lead us to sunnier plains, but clearly to address the black hole that they said they identified of 22 billion. One of the main levers they pulled there was an increase in employers' national insurance contributions, and some businesses, obviously employee-heavy businesses, that's going to add to their challenges. Yes, so we think the high level of insolvencies will continue. Now, actually, just before I move on to this, is really being driven. The total here is being driven by the creditors' voluntary liquidation. So this tends to be the route taken by most small and medium-sized companies. So it was really that driving the total. The green line here is basically a proxy for administrations. Now, administrations are kind of blown up here on the next graph here in the pink line. So these are larger companies. Now, it took a lot longer for these large companies to be affected by insolvency and go into administration process. Why? Because they're bigger, they've got bigger balance sheets, and they've got more financing options available to them. And so these larger cases have not, until very recently, returned to their levels pre-pandemic, and they've certainly not, as you can see, they've not. Whereas the smaller cases really went flying past very quickly where they were pre-pandemic. The administrations have kind of struggling to just even reach the pandemic, and that is a very important point, because before COVID, these were normal at a more normalised level. The administrations, and MANOLETE was taking its fair share of big case referrals. And what, in a nutshell, has happened since the pandemic is we're getting a much higher volume of cases, but slowly that the profile, including our fair share of bigger cases, is only slowly starting to come through. We'll revisit that point in a minute. But looking at our KPIs, really a very similar shape, you'll notice, I hope, when you look at the market, because we are such a market leader, the shape of that graph, the kind of up, down, and then very strongly up and continuing up, is really very much reflected in our KPIs. Strongly up since the IPO, almost trebled the size of the business, sharply down as COVID hit in our FY21, and then a strong increase to above pandemic levels in a big way. And this excludes those kind of 100 plus cases that were referred to us on the Barclays BBL pilot. Again, I'll talk about that in more detail in a few slides. Similarly, exactly the same shape again. So we really are mirroring that market, which went through this extraordinary artificial suppression by the government, but for very understandable reasons. There would have been mass unemployment and social unrest in the UK if they hadn't done that. So there's no criticism of them at all. One side point, one anomaly, a brief anomaly, in the first quarter of this financial year, we only signed 44 signed cases in the quarter. Happily, this bounced back very strongly to almost double that in quarter two, resulting in a perfectly strong outturn for the half year. And October was actually sensational. It was 31 cases in a single month, which is very high. So the reason for the Q1 weakness is very simple. There's always an element of what's called members voluntary liquidations that occur in our Q1, which is the April to June part of our trading year, and these are not insolvent liquidations. These are actually solvent liquidations. So what the shareholders are doing there is liquidating their company, distributing the assets to the shareholders rather than the creditors, and really for tax planning purposes. And the reason why this was very exacerbated this year of all years was, of course, everyone started to see that and appreciate that a general election was in the offing, and they were looking at the opinion polls, and it was looking more likely and more likely that the Labour Party would get in, and the worries about capital gains tax and inheritance tax, etc., started to come to the fore of people's minds. So if there were any owners of farms who sold their farm or passed their farm on, or the assets onto their family in May, June, they beat Rachel Reeves to the punch. The key asset test is, of course, delivery and cash. We'll look at cash in a second, which is really the high point of highlight of this set of results. So we settled a new record, 137 case completions. That was 18% higher than last year. Record gross settlements, another record for the company of 13.9 million. And that is really a very impressive 51% higher than the 9.2 million this time last year. And that those settlement proceeds, the aggregate from all those 137 cases that the defendants have agreed on a legally binding basis to pay Manolete partners, gives us obviously excellent visibility for near term, very much more cash income to come through on top of the cash we've already had in the first half, because most of the cash we get paid on average we receive within the 12 months of completing the case. And because we've got restrictions on the defendant's properties, etc., very good at enforcement if anyone tries to wriggle out of what they signed up to. that we can pretty much take to the bank. We have started to see now a more consistently improving average realized revenue per completed case. So to get to our revenue number, you've got the volume of cases we complete, the 1 through 7, multiplied by the average settlement value of each of those 1 through 7 cases. Now, pre-pandemic, this was at 200,000 per case, because we had those bigger administration cases in the profile that we were taking on. And as I've been at pains to point out in the first few lines, those administrations have only just started to come back to those levels. But happily, if you look at the trend of this arc, as we call it, the average realized revenue per case, we've gone up from 81 in the first half of last year. At the year end, we had that up to, I think, 93, if memory serves, and then 109 at the end of this half year. So that's all going in the right direction. I won't dwell too much on the rest of it. It's very easy to read and just a lift off from the results you would have seen. Let's move on to cash generation. I think this really was the period where anyone with any doubts about our ability of our model to generate very, very significant cash at a time when cash is of course very strained for many people and many companies. It is certainly this half year. On a gross basis, so this is the total money the defendant's paying over, we now have 6 periods there. One could go back earlier, where we have constantly increasing on a compounded basis by 39%, the gross cash coming into the company's coffers, Manolete's coffers. So a huge jump there. Mark will drill down into the percentages in a minute, but from 8.7 to 14.3 million in 6 months is highly impressive. A business that, you know, a few half years ago was at 4.2 and 6.2, and it has only just come out of that COVID suppression. This is really quite remarkable, and I would hope listeners would agree. On a net basis, so this is taking that gross cash and just what Manolete keeps of it, which is its costs that it's laid out to complete these cases, and its profit share, which is usually 50-50. Excuse me, I'm suffering with a cold. 50-50 with the insolvent company of what remains, and usually a lot remains. Costs are usually around 15-20% of what was the gross was. So what's again great to see that is that the cases organically are now generating very much larger amounts of cash, and that's cash that is organic and kept by us. That then covered very strongly every single penny of running the company for the 6 months. So even after paying for salaries and marketing and properties and rent and rates and all the rest of it, we still had an excess of 4.4 million, which was terrific. And that's a fourth half year in a row where that track record has been proven. And as Mark will take you through in a minute, that then covered all the costs of running the new cases and buying the new cases, and then paying down some of the net debt to HSBC from the RCF. A lot of you would have seen this before. It's called the vintage table. Very grateful to our cousins in America, Burford, who started doing this. And we just thought, well, that's great disclosure. Before we listed, we said, we'll definitely copy that. And so the highlights from this, as you will see, a lot of cases. This is really whereas other litigation funds are backing very big cases that obviously they don't control. They're just funding someone else. So they take, I think, around I've been told 5 years on average to complete, and then they've got to enforce, get their money back. Get their proceeds back. We turn them around in just a year to legally complete them, and then within 1 more year to get all the cash in. So that's why you'll see there are 0 cases not completed in all of these years. If you look at any other litigation funder who chooses to disclose this information, sadly not all of them do, you will see a number of cases going back 5, 6, 7, 8, 9, 10 years. There's only one left in from the 2020 vintage, and even the other vintages are very high completion rates, so 94%, 90%, even 23, 75%, even last year. Almost half of them have been completed. And here we see the very large tens of millions coming through every single year. Ditto the gains, and then ditto the durations are very, very fast. The return on investments are very consistent, on average 115%. The money multiple, so for every pound we put in, we get on average 2.2 times back, which is incredibly high in the investment game. And IRRs of 130%. That's what's called internal rates of return. When I was a little nipper in corporate finance, the venture capital and private equity industry was just starting, really in the UK in the late 80s, early 90s. And what was seen to be a very, very good return for investors over a 7-year period from start to finish of investing in private equity and venture capital was a 30% internal rate of return. And what you're seeing before you here is 130% delivered over many, many years on a highly consistent basis across over 1,000 cases. Very quick update on the BBL pilot, the bounce back loan pilot that we've been doing with Barclays very successfully. This has really been paused, as I said just in the presentation a couple of months ago, because of the general election. We got to the stage where we completed around half the pilot cases. The results were stunning. Barclays told us very clearly that before, on all the other methods they used to try and get recoveries on these defaulted bounce back loans, and Barclays were the biggest distributor of them in the UK. Their recovery rate was less than 0.1% of the bounce back loan, which is horrendous because the bounce back loan is our money, that's taxpayer money. MANOLETE within just a few short months was 60% and upwards, and so it was just proven that it works really rather well. And these bounce back loans were really in our zone of expertise. We didn't even use expert lawyers to do them. They were we just used the capacity within our internal legal team. So everyone was super impressed with that. We had meetings with very, very senior, really very senior gatekeepers in the civil service. They were delighted. The election got called in the middle of those discussions. We were told that we would be recommended to the new minister, whoever it was. What we know from then is only external facts. We've not had anyone contact us as yet. But what Rachel Reeves has made very plain, very clear, very rightly, she has said that this is a major target area for the new Labour government. This is our money, this is hospitals' budgets, this is defence budgets, and this is Stop the Votes budgets out of the public purse, and it's a lot of money. There were £51 billion of bounce back loans. Already the government has had to pay in guarantees to the banks £8 billion, and it rises every quarter. And unless the government is seen to be taking very strong action and very effective action, that default rate will get higher and higher. And with a black hole of 22 billion and 40 billion and national insurance contributions, this is really material, actually. So what Rachel Reeves said in her budget, not to us, in her budget speech, which I listened to very closely about halfway through, she said she's very close to the appointment of a COVID corruption commissioner. And she expected to announce that really pretty soon. And I think we'll find out then whether there will be a role for MANOLETE, depending on obviously how the new Labour government want to try and recover this money for us, or whether whether they won't be, and we just can't tell until someone contacts us. Again, an update on the cartel cases is really very much the same explanation as one I gave just a few short weeks ago. We are in negotiations with several parties. One is particularly well advanced. That's I can't remember if I said that last time, but I'm happy to say it now. But of course, there's nothing to say until there are concrete results on these. But we will be making an announcement as we complete these, if and when we complete these on settlements. If we can't reach settlements with any of these defendants, they know they're liable to pay. That the liability has been fully established. It's just how much. There are then cases that are identical to ours, the British Telecom and Royal Mail test cases, and the defence have paid millions of pounds at very high cost levels to BT and Royal Mail. So they are defending the indefensible and spending a lot of money doing that. So let's see how they want to progress it. I'm going to hand over to Mark. Mark, I'll give you control of the slides as well, if that's okay.
That's great. Thank you, Stephen. So this is just a quick summary of the results for the 6 months to 30th September 2024. Just to pull out a few highlights. Realised revenue, which is actual case completions and revenue generated from those completed cases, was 15 million. That's 60% higher than the same period last year, where we had 9.4 million of realised revenue. Gross cash generation, again, this is cash, both our and the IP's share, from completed cases this year and cases that are still paying us from previous years. Was 14.3 million. That's 63% higher than the same period last year. And just to pull out one more, net debt was 11.9 million at the end of September, and that compares favourably to the 12 million at the same point last year. I'll talk about that a little bit more on a later slide. So just to drill down into the profit and loss. Gross revenue was 14.4 million, and this is increased by 28% on the same period in the prior year. As most of you know, our revenue is split into two components: realised revenue and unrealised revenue. Realised revenue is the 15 million I just previously mentioned. That was generated from 137 case completions at an average revenue per case of £109,000. Last year's comparison was 9.4 million across 116 case completions, which was an average of 81,000. So obviously a considerable step up there in average revenue per case. The unrealised element of our revenue was negative 0.6 million. This is a result of removal of high value of completions, whilst the new cases signed weren't quite of high enough value to fully replace those completions in this 6 month period. So overall, our gross margin was 30%. If you look at realised gross margin only, it was 33%, which is unchanged on the prior year, obviously based on much higher volumes this year. Continuing down the profit and loss, overheads were 3.7 million for the 6 months, which is 9% higher than the first half of last year. This is obviously a function of increased staff costs, mainly annual salary increases, and a higher bad debt charge this year. Itself was a function of higher debtor balances due to high completions. So this all results in an EBIT profit of 0.7 million for the 6 months and a PBT loss of 0.2 million following interest charges of £843,000. Onto the balance sheet. No significant changes really on the balance sheet. Just to point out, a portion of the cartel cases, the investment in the cartel cases, has been moved from the long-term investment in cases to the short-term investment in cases balance. This is just really a reflection of the expected completion date of a proportion of that cartel investment. Trade receivables are higher this year, as previously mentioned, 29.3 million if you look at both long and short-term trade receivables. This is just a factor, obviously, of the higher value of completions in the year. Debtor days remain consistent with prior year. Net debt was 11.9 million, as previously mentioned, and this consisted of drawn down debt of 12.5 million and positive cash balances of 0.6 million. Hence, we have 5 million of our 17.5 million facility, which is unutilised. Onto the cash flow. And the cash flow was a record cash generation for this 6-month period. Gross cash receipts of 14.3. I'm going down that right-hand column there in the table. So gross cash receipts of 14.3 million. Once we pay away the IP's share, that leaves us with 7.6 million. Pay our overheads, primarily salaries and other professional fees, that leaves 4.5 million. Then all the cash that we've invested on live and new cases was 3.3 million. So that still gave us a positive cash of 1.2 million. And we used this cash generation plus existing balances to pay down some finance costs. So we repaid 1.25 million of the HSBC loan in the 6 months and paid 0.75 million of interest. So 2 million of finance outflows in total. Final slide from me. Just to recap on the HSBC funding status. So we've got a 17.5 million facility with HSBC, of which 12.5 million is drawn down, hence 5 million is unutilised. All covenants have been met since the realignment of covenants with cash metrics in March 2024. So that's 3 quarters so far. A loan refinancing exercise is due to commence in January. And this is well ahead of a June 2025 expiry of the HSBC loan. We're also speaking to a few other potential lenders, but at a very early kind of indicative stage. So I will hand back to you, Stephen.
Am I muted?
No, you're okay. I can hear you.
Great. Yeah, so just a quick wrap up before we go to Q&A. UK's by far the leading specialist insolvency litigation financing company. It's a unique model because we buy the claims, and it is because of our ownership of the claims uniquely that we are able to drive much faster returns than in the funding model. This is not to say that it's better or worse in the funding model, because they are almost different industries, and I think someone like my good friend Chris Bogart at Burford would fully endorse that comment. Significant expertise. You do need expertise, and in this area, it is highly specialist. There have been 1 or 2 companies that have tried to compete and fallen very foul. A number of you will remember the Islero Lionfish efforts by Rosenblatt law firm PLC, which folded their efforts very quickly. I think they said they got 1 insolvency case in a year. So there's a real moat around the business. There's also a brilliant team within the business. We have nationwide coverage. We are people full time on our payroll from Edinburgh down to Southampton, Leeds, Newcastle, Manchester, Liverpool, etc. The board, I think, made the right calls as a whole. This isn't me claiming credit or Mark claiming credit. As a whole, I think we read the situation well, because you'll remember we told you that we were investing in new people, new heads, marketing ahead of what we thought would be a sustained period of high levels of insolvencies. That certainly has been borne out, and we do see that is likely to continue in the foreseeable future. Mark and I and Nina, our managing director, have decided to start adding new heads to the legal team and the business development team. Because now is certainly the time to make hay. The short durations are, again, the shortest in the industry. I don't think anyone would challenge that. We have clearly, particularly this half year, filled out the picture for cash generation, which is really the acid test for any company in any industry. I think very, very well. It's been growing very strongly, and now really was at highly impressive levels in just a mere 6 months of this trading year. Very high operational leverage at this point. That actually, I was just having a look at some of the questions that will come back to one of the questions. So the team we already have in place and been working for us for a good couple of years now, are able to manage upwards of 520, 530 cases. We've got 513 live at the moment. So there's excellent redundancy in the infrastructure that we've built, and so any new cases, any increased size of cases, as I was at pains to try and explain a few minutes ago, will basically drop very, very quickly to the bottom line. There are no incremental costs. As I said, we might return to that to one of the questions. And we've clearly demonstrated over a very long number of years and over 1,000 cases now, very high investment returns in terms of return on investment, internal rates of return, money multiples, etc. I will hand back briefly to Alessandro while we have a look at the questions. Thank you.
Perfect, Stephen, Mark. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. So if I could hand back to you just to read out those questions and give responses where it's appropriate to do so, I'll pick up from you both at the end.
Super. This is a very long question, and I don't think there's no need to read it out, to be honest. It's basically, it's a perfectly decent question on the cartel cases, truck cartel cases. We've stayed it for a long time already. We're getting into settlement negotiations. This is the question, just laying it all out. How much longer would you keep it there before you secure a settlement? And because of course, the longer you leave it, the less the settlement's worth. I suppose in net present value terms, although interest does run on these cases, even in settlements, 99 times out of 100. We will secure lost time, cost of money. So would we push it forward with by issuing the claims and unfreezing these? Now, there are a number of factors at play here. I'm not going to go into any detail on this because it would be pure folly. This is live litigation. This is live negotiation. For all we know, if you're shareholders of ours, then DAF, Mercedes, they could have their own people, their lawyers, listening to every word I say or watching the recording that this company does very well indeed. So I'm just going to make one generic statement: is that we've been doing this on thousands of cases for 16 years now. We will use everything in our power to secure the maximum returns for our shareholders, and all that you mentioned is being considered all the time. Alessandro, I'm going to delete this if that's okay, because I got very muddled last time. Is that okay?
I'll remove them once you've answered them.
Oh, fine. Okay. Is it possible to calculate? This is one for you, actually, Mark. So I'll let you read it out.
Yeah, okay. Is it possible to calculate IRR on cash out, cash in, rather than a settlement basis, please? I mean, our IRRs are calculated on an industry standard, and also that historically we want to be consistent on how we calculate them. So for each completed case, it is based on internal returns, i.e. cash spent and then cash recovered, if that's what the question is getting at. But we always define our calculations, and I think we'll leave them as they are.
Yes. and I believe they're consistent a lot across those companies that as much as one can tell. So the next one is a very good question. I'm glad it's come up because ever since litigation funding has caught the eye of the investment world, there have been lots of debates about how one applies accounting policies and standards and disclosure to all of the listed companies, and rightly so. There was a huge long debate and a great big furore, of course, with the fair value debate, and you had companies like Litigation Management holding very hard to the cash accounting, and then moving over to the fair value accounting, the way that Burford and Manolete were doing it. Omni Bridgeway in Australia, I think they're still more on the cash accounting side, but I could be wrong. They're not listed in London. What you've got in our P&L and our cash flows, most of the time, the investment community will get very frustrated because companies will show very strong profits, but very low cash flows. So it's called a cash conversion rate. I think it's between profits and cash, and that's usually the head scratch. Oh, profits are great, but it should be the cash prove, the real proof of the pudding. Manolete is the opposite, and I will explain why that is so. And I'll do this very simply as I can, and I don't mean that in any way demeaning by saying that. It's actually quite complex accounting with analysts earlier today, and one of the analysts sent me an email straight after. He said that was very well explained. None of us had understood that, and it landed very strongly. So I'm going to give exactly the same to you, ladies and gents here. So we have the opposite with money. We've got a very, very strong cash profit this year. And this is why it's kind of frustrating that we can't, just dispense with all the accounting and just be like a post office, just cash in, cash out in the money box, because we would be showing after expenses a profit of close to £5 million in cash, and that's fantastic. What sadly people will see is the failings of accountancy profession towards litigation funding, and the trouble is, in our profit and loss account, there's what I call, as a joke, and I will explain myself in a minute, Einstein's theory of relativity applied to accounting. And what I mean by that, if you remember with Einstein, he was always talking about a train going that way, and then you've got a kid standing on the train. The kid jumps up, but the train's going that way, and then the kid, lands on the train a lot further down. That is, as I understand it, the theory of relativity in basic terms that I can understand it. And that's really what's going on with our P&L, which makes it really very unsatisfactory. And frankly, I think misleading, but we are where we are. So let's just go two big buckets. So all of our revenues in this period were actually realised. There were negative unrealised fair value. So that makes it simpler. So what are the realised revenues saying to you? The record 15 million realised revenues. What's it over across 137 cases? What that tells the reader is that that's what the team, the Manolete team, the legal team, the finance team, the net worth team were doing about 1.5 years ago. They were buying those cases around then. I think the duration was 15 months, something like that. Mark,
15 months.
So, and those cases have been completed within the 6 months of this first half of this financial year. Okay, and that's why they are realised revenues. But that's what we were doing 2 years ago, well, a year and a half ago. So that's a revenue line is 2 years out of date. In broad terms, we won't receive all of that cash for another year. So even the cash flow hasn't got the benefits of that, let alone the profit and loss account. So that's revenues dealt with. Costs. Every single cost in the P&L account is H1 cost. of this financial year. The salaries, the marketing, the rent for the few offices we have, even the interest we've paid HSBC, even in the cash flows, the repayments, they're today numbers. The revenue, the way speed of light that we work at, and in Einsteinian terms, was you're looking at, if you look at the sun, that's how the sun looked 8 minutes ago. It takes 8 minutes for the light ray to hit the retina in your eye. That's what the revenues do. So you're not matching your revenues with your current costs. In fact, let's put it another way, you're putting your old economic activity, the revenues, with your current costs. And that's the simple fact of it. And that's why the P&L just does not show a fair, in my view. And clearly it landed with really quite a big room of analysts that we spoke to this morning. And I think that is right. So that is what it is. And it's a brilliant question. Someone else also asked a very similar, in fact, this very next one, Peter D, could you explain, this is it, significant rise in costs, which have risen much more than revenues. Now, sorry. I see. Sorry, got deleted. Sorry, this is slightly. Actually, Mark, do you want to look at this, because this is more revenues and cost of sales?
Yeah, this is different because cost of sales recognise when a case is completed. So your completed, your realised revenues and your cost of sales do match at the same time. And if you look at realised revenues against cost of sales, the gross margin is unchanged from the same period last year. I think where it's making you look as if it's higher is because you've probably taken total revenue, so you've deducted the negative unrealised revenue. So it gives the impression that the cost of sales are a higher proportion. But if you just look at realised revenue versus cost of sales, you'll see that the realised gross margin is pretty much unchanged at about 33%.
Excellent answer, Mark. I would add one thing again, just to broaden it in cash terms. All of the costs in cost of sales we've paid, because we pay as the case is progressing, and that started 15 months ago. Yeah. So all of that in cash was a negative in our cash flow 15 months ago. The realised revenues we've probably only collected, because we've got a year to collect those on average, probably only collected, a third, half of those. So again, for us to report such strong net cash is a really fantastic milestone and a very great achievement for this company. James E, I'm feeling this might be a bloke you used to go to university with. Please help us understand how you think about constructing your portfolio of cases based on prior experience. In particular, the large cartel cases have been awful for cash flows. You wait till the money comes in. While the small claims continue to disproportionate amount of OPEX. Yes, I'm not. So he's saying, how are you going to optimize your portfolio in when you reflect on how the past has been? I think, in all fairness, James E, you've picked really on two of the outlier edges of our portfolio. We've invested in 1,000 round numbers, 1,500 cases. 22 of those were cartel cases. Shoot me. Any bulk of smaller cases was our stress pilot, which is a test bed with Barclays Bank and Her Majesty's government on bounce back loans, which was very exciting for us because all you shareholders, including me, including Mark, would have spawned a completely new, enormous £8 billion recovery business for free compared to the point in time when you bought your shares, because it wasn't an option. It was going to be, it still might be, a completely new subsidiary joint venture. An awful lot of work had been done behind the scenes on that. I hope it comes to pass. But James, in answer to your question, those really are two outliers. The vast bulk, the 95% of the other 1,500 cases, are really very standard. They're bigger, smaller, medium, whatever, of the same 7 deadly sins, we call them, wrongful trading, directors' loan accounts, blah, blah, blah. So I will move on, if that's okay. Mark H, why are you suing Barclays Bank for breach of fiduciary duty when you deal with on and bounce back loans? Yeah, I've seen quite a few people kind of coming up with crazy conspiracy theories about this on some of the message boards. Look, the bounce back loan with Barclays, and yes, we've got a straightforward insolvency claim that we bought from an insolvent company via a liquidator or administrator. I can't remember who in this case, and we think that company had a claim, and the creditors have got a claim via us. We'll pay for everything against Barclays Bank. The fact that we're doing the BBLs with them doesn't change our thinking at all. We sued a very big audit firm and took £9.5 million off them. They refer cases to us. It's even closer because they're ongoing. So no, I've always kept, the board has always kept, John Moulton, my very strong strategic shareholder. We've always been very, very passionate about keeping MANOLETE completely market neutral to enable us to do exactly these kind of things. So whether we want to go for that audit firm, there is no special relationship. We've had law firms, listed law firms even, coming to sit down with me for hours and hours and hours, and trying to come up with a special product that we could brand X PLC law firm and MANOLETE. No. We work with every law firm. We work with every IP. And that's held in great stead. And the same applies to the people we go after. Barclays, no one gets special treatment. I remember a very good album back in the day called No One Is Innocent by a punk group in the late 70s, and that's certainly what applies here. Peter D has another one. If cash generation is so strong, why is net debt only down by 0.1? Well, there's 0.1 for the last half year, Peter. At the last most recent time, dear chap, it was 12.3 going down to 11.9. So that's 400,000. Thank you. Moving on, Alex C. Haven't BBLs up? Definitely. Yes, great point. I should have mentioned that. Given the most profitable use of principal's time, Alex, sorry, I think I've answered the first one, so I won't read it out. Could you sell part all of your interest? Yeah, again, Alex, I don't know what you do, but you could have a future in litigation finance. If you want to drop me an email, no, you're thinking very well. These are this kind of stuff that Burford and people are really pushing the edge on. Could you syndicate? And Burford have done this. I mean, in fact, a massive hats out of them. Some of the cases, and that's very exciting. I'll say we did look at doing that very early on. In fact, we had an offer from another funder, but again, to maximise shareholders' value, we didn't go down that route. And please do recall that I am, I think, still the 4th biggest shareholder in this company. So I will always do what's good for me, which equals what's good for you. I think you'll be happy to hear. I'm on my last question. So interest awarded on damages is well below the IRR that you could generate on claims. Yeah, fair enough. But James E, you're absolutely right. It is, but it's not as though we're only losing the differential in the interest. That's the correct way of explaining it. And quite honestly, the interest is at the margin. Yeah, I don't think it's a hugely material point. Alessandra, I think we're finished with the They were excellent questions, by the way. Really very good. Thank you.
Thank you very much for answering the questions from investors. Of course, the company can review all the questions submitted today, and we will publish those responses out on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to you both and the company, Stephen, could I just ask you for a few closing comments?
Sure. Cash is king. There's that saying by the chap who wrote the book, that revenues, flattery or whatever his profit is all right. but cash is king. Alan Marvin, or so, I forget his name. And we've delivered. I had a lot of institutional shareholders send me along the way, look, love the idea, love the way you're building the business. Some even sent me, I remember the Premier Myton chat, lovely chap who runs that, sent me Christmas cards. Well done, scaling the business, Steve. But of course, as COVID hit, we were about to break through with the cash numbers that all these really smart guys wanted as their final piece in the jigsaw. And now we've done it. It really killed me that we put back on the canvas with COVID for 2 years and more, but now we've done it. And long may it continue. And I know it's been a very rocky ride with COVID and share profits and all this, and muddy waters and all this kind of stuff. But God willing, we're on for a calmer path ahead. And I think those graphs, those cash graphs, show we're doing the right thing. The team is doing the right thing. Thank you very much indeed, all of you.
Stephen, Mark, thank you once again for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MANOLETE Partners PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.